Welcome back to Wealth and Wisdom. If you've been following along, you're already building a solid foundation for your investment journey. But now you might be wondering, how do you pick individual stocks to invest in? Well, today we're diving into the key metrics and tools that will help you evaluate individual stocks and determine if they're a good fit for your portfolio. Let's get started. When evaluating stocks, the first thing you need to understand is stock valuation. How much the stock is worth relative to the company's financial health and growth potential. The key is to determine whether a stock is undervalued, overvalued, or fairly priced. Let's start with two of the most important valuation metrics: price-to-earnings ratio, or PE ratio. This is one of the most common metrics used to assess a stock's valuation. The PE ratio compares a company's stock price to its earnings per share, or EPS. A high PE ratio could mean the stock is overpriced, or it could mean the company is expected to grow rapidly. Conversely, a low PE might indicate the stock is undervalued, or that the company is facing challenges. For example, if a stock has a PE of 20, it means investors are willing to pay 20 times the company's earnings for each share. A PE ratio that's high compared to its industry could signal overvaluation. Price-to-book ratio, or PB ratio, compares a company's market value to its book value, which is its assets minus liabilities. A PB ratio under 1 might indicate the stock is undervalued, suggesting the company's assets are worth more than its stock price. By using both PE and PB ratios, you can get a better idea of whether a stock is priced fairly, or if you're paying a premium. Another crucial factor to consider when evaluating stocks is the company's earnings growth and stability. Earnings growth is the percentage increase in a company's profits over a given period, typically over the past few years. This can give you an idea of how well the company is growing and whether it has the potential to continue growing in the future. Look for companies with consistent earnings growth, ideally in the range of 5 to 10% per year. A company with strong and consistent growth is more likely to be a stable investment in the long run. You also want to assess earnings stability. A company with highly fluctuating earnings may be more vulnerable to market changes, economic downturns, or poor management. Companies with stable, predictable earnings are typically better investments, especially if you're in it for the long haul. Next up, we have the return on equity, or ROE. ROE is a measure of how efficiently a company is using its equity to generate profits. It's calculated by dividing net income by shareholders' equity. A higher ROE means the company is using its shareholders' investments more efficiently. As a general rule, an ROE above 15% is considered strong. If a company's ROE is consistently high compared to its peers, it suggests that the company is effectively managing its resources and generating value for its shareholders. However, be careful. Extremely high ROE figures could also be a sign of leverage, where the company has a lot of debt. Always assess ROE in the context of the company's financials as a whole. Speaking of debt, let's talk about the importance of debt levels and financial health. A company's debt can significantly impact its ability to grow and weather economic downturns. This is where the debt-to-equity ratio, or DE ratio, comes into play. The DE ratio compares the amount of debt a company has to its shareholders' equity. A low DE ratio typically indicates a company with conservative financial management, while a high DE ratio suggests the company may be over-leveraged and at risk of default if economic conditions worsen. For most industries, a debt-to-equity ratio of less than 1 is considered safe, but this can vary by sector. Some industries, like utilities, tend to have higher debt levels because they require a lot of capital investment, while tech companies tend to have lower debt levels. If you're interested in generating income from your investments, you'll want to consider a company's dividend history and yield. Dividends are a portion of a company's profits paid out to shareholders, and they can be a great way to generate passive income while you hold on to your investments. When evaluating a stock's dividend potential, look for dividend yield. This is calculated by dividing the annual dividend by the stock price. A higher yield can be appealing, but be cautious of extremely high yields, as they may indicate financial trouble or an unsustainable payout. Dividend growth. A company that consistently increases its dividend payout over time can be a great sign of financial stability and confidence in its future earnings. For example, a company with a 3% dividend yield that has been consistently growing its dividends for the past 10 years is likely a reliable income-generating investment. Lastly, don't forget to consider market sentiment and industry trends when evaluating individual stocks. While financial metrics are crucial, understanding the broader market environment and how a company fits into that is also important. For instance, a company in a rapidly growing industry like renewable energy or cloud computing might have more room for growth compared to a company in a declining industry. However, remember that trends can change, so always assess whether the company is adaptable to future market shifts. Additionally, paying attention to news, earnings reports, and analyst opinions can give you insights into how the market views a particular stock. So, there you have it, the key metrics and strategies to evaluate individual stocks. To recap stock valuation, look at the PE and PB ratios to understand if a stock is undervalued or overvalued. Earnings growth and stability. Check if the company has consistent, predictable earnings growth, return on equity, ROE. Evaluate how effectively the company is using its equity to generate profits. Debt levels and financial health. Assess the company's debt-to-equity ratio to understand its financial stability. Dividend history and yield. If you're looking for income, check out the company's dividend yield and growth, market sentiment, and trends. Consider the broader market and industry trends. Evaluating stocks can be complex, but if you take the time to understand these key metrics, you'll be well on your way to making smarter, more informed investment decisions. Thanks for tuning in to Wealth and Wisdom. Don't forget to like, subscribe, and hit the notification bell so you're always updated with our latest videos. In the next video, we'll be talking about how to build a diversified portfolio with stocks, bonds, and other assets. Drop any questions or comments below. I love hearing from you. Until next time, keep evaluating wisely and investing smart.